Thank you so much, Mr. Chairman. Reviewing your testimony, and if I can just get you to agree, we all know that a foundational principle in all of this is preserving the 30-year fixed-rate mortgage.
Yes.
Absolutely.
Mr. Marco?
Yes. Sorry, yes.
Thank you. So I don't have to ask that question then. I'm concerned about the rental market, which, Mr. DeMarco, in your testimony, you made a critical point that one of our greatest challenges is actually in the rental market. You correctly point out that QM rules generally require household debt be no more than 43% of families' monthly income, where we have 11 million renter families spending more than 50 million or percent of their monthly income just on rent, not getting any equity. You know, that idea that your equity in your home was going to be the third leg of your retirement stool, you know, when you think about your Social Security, equity in your home, and some kind of pension / 401k, we no longer have that third leg because of this problem. Are there improvements to the way we handle the multifamily portfolio at Fannie and Freddie that could help address high rental costs? And I'll ask you, Mr. DeMarco, to go first.
I'm not sure that the financing side, and particularly the role that Fannie and Freddie are playing in securitizing multifamily mortgages, is the constraint or the barrier here. They're really on the renter side. It's income growth, right? It's stable jobs, it's growing income. And on the supply side, we have some real challenges in a lot of communities with regard to having developers be able to either rehabilitate or bring new multifamily units online quickly. And there's several reasons for that. The Obama administration actually last year, had a report outlining some of this, but it goes to building requirements, zoning restrictions, and
I
other
only have
things that
so
need to go
much.
in.
We can maybe get some other opinions on this. I only have so much time.
The challenge is, and if you look at both Freddie Mac and Fannie Mae's multifamily programs over the last couple of years, as you know, there's a cap. They set a limit to how much they can lend, and they've come near those caps, and not enough of that has been affordable. So what Director Watt has done under his leadership, as he's modified the cap so that you're unlimited if you provide, if it's affordable. So that's a step in the right direction. But I think for Ed, he highlighted some of it. But I will tell you that a real challenge here is the demographic mix of who's renting and who's owning, and the pressure of the millennial generation delaying their decision to buy and putting upward pressure on rent rates. And that's affecting long-term renters and pricing them out of their ability to afford the rental. Yes, wages are really the core part of this, but on top of it, we're seeing unique upward pressure on rents because people are not going to buy homes at the same ages that they used to before.
There was another report out today talking about the lack of savings for that down payment. Millennials, I think in this report, 1K, that's the extent of their savings. They're paying off their student debt. They're living in higher cost cities, which I think has an effect as well. I mean, one of the things I would suggest that we could do is encourage diversification, not put all of the Google employees in the high price areas and look at lower cost locations. But we need to have this discussion, and so I just wanted to lay down a marker. I want to talk about access to secondary market for small lenders. We tried to address this when we were doing the Corker-Warner analysis and work a couple years ago. And one option we explored as part of Corker-Warner was expanding the role of the Federal Home Loan Bank to serve as an aggregator of small loans. What's your view on allowing the Federal Home Loan Banks to actually be an aggregator so that we can have greater access to the secondary market? And we'll start with you, Mr. Stevens.
It's a complicated question, so this is a follow-up one. But I actually thought that was a workaround because under the way the legislation was written, there was a concern that small lenders wouldn't have access to the main system.
Right.
I worry about the ability to have effective, what we call execution, pricing for small lenders if you use only the Federal Home Loan Banks as the aggregator platform. As you know, the Federal Home Loan Banks work with community banks today. They all get access to a home loan
Well, they
sale.
all have a relationship.
That's correct. But non-bank originators do not have access to that system. And we believe strongly that the Federal Home Loan Bank is a tool here that can be used as you think about GSE reform to affect the overall market. But I would say the way we've resolved it in our plan is We think addressing the small lender issue is actually critical, and based on the debates we've seen over the last few days, just over this hearing, that's the case. Making a cash window that's at the same price with the same credit terms in the new guarantor model gives an outlet for all small lenders, regardless of size and regardless of business model, and it doesn't force them into some other system that, because of liquidity and size, may not get them the same pricing ultimately. So we need to consider all the levers.
Mr. Chairman, I'll follow up with written questions.
And
Mr.
can I add
Calhoun,
two just quick
you
statements?
got to
Yes.
ask the chairman
The-
if you can do that.
If you're very brief.
The Federal Home Loan Bank is, as Mr. Stevens said, it's helpful, it's not sufficient. They've got to have a workable cash window. It can't be a substitute for that. On the rental housing, one thing is we've got to preserve the things that are really helping. Those include the important role the GSEs play in multifamily financing, and also things like the low-income housing tax credit. If you don't preserve that, you're suddenly making the problem even much worse.
And I thank Senator Heitkamp for helping me keep an eye on the clock.